Hi there Etoro, it is Monday the 4th of July, and that means it's time to take a look at what moved the markets last week. Starting with the charts, as we usually do, so 3 weeks ago we saw a bounce, but through the last week we've seen a pretty chunky drop. These are 1 week charts, by the way, for the NASDQ100, the SP500, fairly fat red candles there, particularly for the NASDAQ. We can also see that the energy sector fund, the XLE, it bounced about a week ago or so, but it does look as though that bounce was a dead cat bounce. So energy stocks within the US dropping once again through the past few sessions. And China, as I've said for the past few weeks / months now, the CSI 300 seems to be marching upwards, rapidly approaching the 200-day moving average. It's been a bit of a bumpy ride for Chinese equities, but the direction for most, the momentum, seems to be on the up. Continuing the trend for, let's say, the past month or so now, we can see that a number of commodities, including natural gas, iron ore, copper, lots of metals in there, have been dropping over the past week and are now significantly down over the 1 month period. Oil seems to be stubbornly holding on to the price levels that it's been sitting at for a while now, and this has a number of pundits asking the question, why? In terms of economic data that we got last week, there was quite a few data points put out there, and it feels as though they're signaling a turning point in several different areas. I'll give you a few examples. So consumer confidence in the US, slightly down from what was expected. US GDP down. It's been expected that this number would be negative for the past 3 months or so, slightly more down than what was anticipated. Inflation, so this is the Fed's favorite measure of inflation, slightly down from what was expected, and this is definitely in a downtrend now, but it excludes certain things. I'll talk about that in a moment. Once again, jobless claims slightly up, and ISM manufacturing PMI slightly down. So to summarize that, looks as though unemployment is slightly up, growth is slightly down, at least in terms of month-on-month rate of change. It's in a downtrend, and inflation is slightly down. So this feels like we're at a pivotal point. So even if you don't read the entirety of the ISM report, I encourage you to read a summary. So the good news is that it's still signaling that the US economy is in a growth trend upwards, although that growth is rapidly slowing. And as we all know by now, the market is pivoting from inflation being the biggest thing to be afraid of to a recession to be the biggest thing to be afraid of. And the question right now is less so, is there going to be a recession or a slowdown in growth, but what is the depth and duration of the slowdown or recession? As I've been talking about through the past few weeks, so the core PCE price index annual change has been dropping for the last 4 months readings. This is fantastic. This means that a large part of the basket of things that makes up inflation, headline inflation, are dropping, but this excludes energy and food, most notably energy, because as I said, those oil prices are remaining stubbornly high, even though other commodities tend to be falling in price. And so what we really need to see is this headline inflation number, because this is what the consumer really cares about. They don't care about the various breakdowns of inflation. And the market knows that the key concern is inflation at a headline level. So when is this going to start heading in the other direction? And then it's going to take more than a single month's worth of data. I feel it's going to take enough data points to form a trend to alleviate the worries about inflation, and then the worry train will move full steam ahead with the recession concerns. We're seeing some really interesting things amongst retailers at the moment, and this is because their inventories are very high. So there are some stores in the US that are trying to decide if they should just let people keep stuff that they want to return, potentially even paying people not to bring them back to the store. And this, if you read through this article, tells you about how much these companies are suffering with the inventories. And this is largely because of something called the Bullwhip effect. So we've seen this play out several times through the pandemic, right from the very early days, toilet paper, exceptional demand for toilet paper. And the way that this typically works is that there's a supply chain, consumers on the one end, depending on which side the bullwhip effect is beginning from, and they overorder at retailers. So, you think toilet paper is going to run out forever, so you buy 10 times what you will ever need. Retailers realize they're going to run out of stock because they don't stock enough to meet this demand, so they overorder at the manufacturers. The manufacturers do the same thing at the suppliers. And so the very initial event, people in this case ordering toilet paper, ends up being amplified through the network of suppliers. The problem then becomes if this increase in demand is not sustained, then everyone in this supply chain is going to end up carrying a lot of inventories that they had just in case. They don't want to say no to their particular customers. So customers are the customers of retailers, obviously. Retailers are the customers of manufacturers, and manufacturers are the customers of suppliers. Each participant in the supply chain is looking to maximize revenue and profit. And so in trying to meet these elevated levels of demand, they may overinvest in their business in various ways. They overhire, they overbuy stores and various other services. So in a relatively short period of time, we've seen the effect of people buying a lot of less stuff because people were stuck at home. They bought things that they wouldn't ordinarily buy, or they bought for the long term. Now with central banks looking to crush demand, and it looks like it's starting to work, people are changing what they're buying. They're buying less of what are called discretionary items and instead focusing on the things that they need, like food and rent. Also, even just talking about inflation and having high expectations about inflation in the future affects the way that consumers and other people behave. Now, the end result of this is that the various participants in the supply chains are probably going to have to offload some of this extra inventory at a huge discount, or just get rid of it and not make any money off of the inventory that they bought. These two things will enormously hit profit margins and therefore the earnings that companies can expect. So some of this has been priced into the market in various stocks at the moment. But it might be even worse than we expected. So I mentioned before when we were looking at this chart that the Q1 GDP number for the US came in at minus 1.6 quarter on quarter. Now the semi-formal definition of a recession is that you get 2 quarters in a row that are negative in terms of GDP growth. And the Atlanta Fed is now saying that the current quarter that we're in is already down by 1% in terms of GDP growth. So we'll get these formal numbers towards the end of this month, I believe. So if this ends up being the case, then the US has already been in a recession for half a year. Now, as I am so fond of saying, the devil is always in the details. And actually, if you track just the domestic part of GDP, exclude imports and imports, GDP in the US has been fine. It hasn't been shrinking. But sentiment is driving the market at the moment. And so the details that the devil finds may not have any effect on overall sentiment. Now I'll keep it coming back to commodities, and here we have raw industrial materials. And this is because this plays an enormous part in inflation. Outside of services, all the stuff we buy needs to be made. And right at the top of the supply chain are the materials that need to be mined and then transformed to make the things that we like to buy. Now we can see how closely here the US ICM manufacturing index follows the year-on-year change in these raw materials. And so I think that we can expect a bit more downside in ISM manufacturing. I'm pretty sure it's going to get pretty close to 50 and maybe even dip below that. Once again, this is not a surprise. I think the whole market right now is completely expecting some form of an enormous slowdown economically within the US and globally. The question then is just how deep and how far does it go? A few weeks ago, I spoke about the fact that it looked as though energy stocks and some commodities looked as though they were rolling over. I've been trying to find a chart that overlays the performance of various equity classes on the business cycle, and I found this by mistake actually. Vlad on Etoro, there's a Vlad with 2 Ds. He shared actually this tweet with me, and then further down I found this nice and simple chart. Now the thing to emphasize is that these are the idealized 6 stages of the business cycle, and for those that are hawk-eyed, you will notice that bonds have not behaved the way that they usually do, and this is something that's created a lot of chatter through the past few quarters. Bonds have been behaving very strangely, although that's probably got something to do with very low interest rates and very high inflation. Anyway, the reason that I wanted to pull something like this out and to show it to my fellow Etorians is that the point at which commodities start to roll over usually signals the tail end of the business cycle, and the tail end of the business cycle is also the very beginning of the business cycle. Now, of course, we don't know exactly the time frames of when this begins, when it ends, and how long it runs for. Everything seems to be running super quickly since the pandemic. We've experienced an entire business cycle in just a few years instead of the usual 8 to 10 years that it takes. But this has got me quite excited. I mean, I don't like drawdowns as much as anyone else. I hate bear markets just as much as anyone else. But the reason that this excites me is that we can see that we are getting very close to what will be another fantastic recovery and bull run. Having been an investor in markets for the past 20 years or so, I've seen quite a lot in terms of drops in the stock market. But the great news is that bull markets tend to be 4 times the duration of bear markets and 4 times the size of bear markets. And it looks as though we're in the final innings of this bear market. We still need to see inflation properly peaking and the Fed at some point after that dialing back their tightening of economic conditions, but we are slowly but surely approaching that time. I mentioned this last week. By the way, I highly recommend that you read Ben Laidler's posts on Etoro. He is a fantastic guy and very, very clever. And just today he put out something that I mentioned last week. So I think the market has priced in the hikes in interest rates through to some point next year, the middle, maybe the end of next year. I think the market has priced in some kind of economic slowdown and even, a shallow recession. And the last thing that we need to see now is whether companies start dropping their forecasts in terms of earnings. Actually, I don't even think it's a question of whether they're going to do it. They are going to do it. It's a question of by how much. The reason that this is important is that the PE ratio for the S&P 500 as a whole, and I spoke about this in more detail last week, is looking as though it's fair valued. And if you look at the smaller cap companies, they're the cheapest that they've been through the past 20 years. The PE ratio is the price divided by the earnings. So if the earnings drop significantly, that means the PE ratio is not truly as cheap as it appears at the moment. I suspect the market will tolerate something of a drop in earnings forecasts, but if we see earnings across the board dropping by 20, 30, 40%, then I think the market as a whole is going to continue lower. Although I do think that would be the last leg down for this bear market. Now, one company that reports earnings quite early on in each earnings season is Micron. Micron is a fantastic company. Their margins have been expanding, their profit has been expanding, their revenue has been growing super fast, but the business is highly cyclical, meaning that the fortunes of the company are very closely tied to where you are within the business cycle. When there is growth in GDP, Micron tends to do fantastically. When things are slowing down, Micron's earnings and revenue tend to decline. Now, they reported earnings last week, and you'll see a number of different opinions all the way from sell through to buy and hold on places like Seeking Alpha. The long and short of it is that Micron did fantastically last quarter in terms of revenue and earnings, but their forecasts for this year have dropped pretty significantly. Now, because Micron is such an important company within the semiconductor industry, a lot of other companies have followed Micron down, as people expect that the other companies that do similar things will also be subject to the same headwinds that Micron is experiencing. So for those people that trade in and out of stocks, they probably would have traded out of Micron a little while ago when it became clearer that there was an enormous slowdown coming, and they would try and time the bottom whenever that might be. However, being a long-term investor, what I am more interested in is, and this article actually is quite negative, but a lot of the data points are very well researched. So, for example, the author here is arguing that the gross margin tends to be the thing that the share price hangs off of. And it certainly seems that there is a very strong correlation between the two. But I don't care about that in the short term very much. What I'm seeing from this chart is that besides the ups and downs over the years, since 2012, Micron share price has been up and to the right. By the way, a lot of these drops in share prices and margins were related to periods of tightening within the US, economic tightening within the US and the world. So what's important here for me is, instead of trying to time getting out of the stock and then getting back into the stock, because it is an incredible company, one of two companies that basically dominates the industry globally, I'm going to hold on to what I have for now, and I'll add to my holding as time goes on. Another interesting company that I was watching through last week because they reported earnings is Nike, a very well-run company. I'm not currently a shareholder in the business. They reported earnings that beat top and bottom fairly well. They're a behemoth of a company, so they're not growing so fast anymore, but they are seen as quite a safe bet, so there'll be a lot of people holding them through tough periods like right now. The reason I was interested in Nike in particular is because it is a well-run company, so I wanted to see how it was holding up, a well-run global company. I wanted to see how it was holding up because retailers are hurting at the moment. And there were a few key bits that were quite interesting out of this report. So sales within China fell by 19%, and that's because of all the lockdowns that were happening in China. But potentially even more importantly is that inventories have grown 23%, and I don't think that hit this quarter's numbers. I think that's going to come through in the next few quarters. They also mention, as most will expect, that inflation is hitting their results, as is foreign exchange. Now, I don't think a lot of investors are appreciating the size of the challenge that foreign exchange is presenting at the moment. All right, so what is going on this week? Well, today is a holiday in the US. It's their main holiday. And although we have some interesting data points through this week, I would say it's largely light in terms of market moving data. The thing that is becoming more interesting to the market now, as I mentioned before, are how good these forecast earnings have been and what changes we might expect. And we're going to start seeing that through next week, maybe a little bit through this week. All right, and that's it for this week. Bear markets are tough, but they do end eventually, and their endings are the beginnings of the next bull market. All right, have a good week. Goodbye.